Good day, all. Ira Epstein of Linn Associates with your agriculture update, and this is for Wednesday, the 29th of May, 2019, and here we are about 4:50 p.m. Central Daylight Time. The reason I'm not showing you the boards I normally do is the market's closed. This is where the July corn closed, the wheat market, beans. We were down in wheat and corn today after being sharply higher today, but we'll let the charts do the talking. We yesterday got the crop progress report. When I was showing you that, and I know I did in yesterday's video, one of the things I was writing last night is I said, it's probably the perfect storm where people will come out to look at that progress, come into these markets, and they'll back off later. The beans are the wild card. They can do anything. First of all the beans that we grow are still going to be too many down the road. Got it? The question is, how many do you get? The question is, what is the government program? The question is, the government doesn't want to encourage farmers not to plant. They want to give them a reason to still plant, even though it's getting later in the planting season for some of the crops. Beans are like a weed. There's still some time here. And in looking at the weekly area chart, you're up 42 cents in the beans for the week. That's not bad, but I see major resistance at that 18-week moving average of closes at 878 and a quarter. You're within shouting distance of it. You got to let's see, on the weekly you got as high as 892 and 3/4, and this is just a closing chart. So you got very close to it intraday. You settled underneath. Remember, this is not a bar chart, it just closes. When we come to the chart itself, I want you to look. You have a gap here and a gap here. If it's real, this is called a breakaway and a runaway gap. They should not be filled. The market should just be able to run higher if it's for real. And I've seen these before, and they can be very real. Once you start a correction, and if you start filling these, one probably fills the other over time. That's my theory. Doesn't mean I'm right. When I look at the pattern, you've come straight now from 817 to a high today of 892 and 3/4. So the market is coming into previous resistance on the daily chart right up in this area, approaching the $9 mark. It's also got another layer that we talked about yesterday of the 100-day average if it could clear the Bollinger Bands, which it did. Let's go to yesterday, which it did yesterday. Normally on this type of pattern, I look for the market to pull back into the band. It completely went out of it today and stayed out of it, unlike the other grains. And I'll show you that in 1 second here. In terms of momentum, you're overbought. So I have a market that's rocketed to the upside. It's 2 days in a row over the top Bollinger Band. It ran from it. I'd look for pros to be pretty aggressive at 903, either coming out of the market or seeing what the still punch in the market looks like. But there's no reason to be short or long here. You still have this pattern of lower and low and a higher high. As a technician, I don't care. When I look at the meal, you punch through and you kept going through today. It's the same type of chart, but unlike the beans, at least this has higher lows, higher highs. Strong as can be. The question is, can the market get under the Bollinger Band? It's about $6 lower. You closed at $3.19 today. In soybean oil, actually I should have an arrow pointing up here. I don't know how I missed that, because now you've got the higher high, lower low. You're not in a downtrend. The question is, can this market be pulled along to go higher if beans and meal keep going higher? You finished today at 27.73. I want you to look at the Bollinger Band, 27.77. I realize you got over it, but you came back and stayed within it. Still a sign this market's not ready to completely break out to the upside. In the corn market, for me, what rules today is as long as the market keeps its embedded reading, that's a good sign. Now, where did the market close in the day's range? If we step right here, 438 was the high, 412 and a quarter the low. You closed in the bottom part of the day's range at 418 and 3/4, back under the Bollinger Band by about a penny and a half. So, if you lose the embedded reading, that will be a very bad sign tonight that price and this area, the 100 and the 18-day average, may again come into play. I think that you saw a lot of hedging today going on. One of the things that we've been talking about is that 450 zone, and D's corn cleared that zone. Old crop corn got within that 450 by 12 cents. I just think that this is an area that you're seeing some hedging going on. By the way, weather markets, if they last, there's no number. I mean, everything goes crazy, but you play that there's a life to a weather market. You get right where we're at, where everything looks bad, everything's flooded, it's cold, it's not right, the growing days aren't there, and then magically you get later along in it and things get a little better, and then you have to go through that growth period for a bit. Is there enough moisture still left? The ground was saturated. Is it too hot? What's drying out? There's lives that come into it, and of course then, how does the crop look at the very end? And that's months away from now. But even the wheat market, look at this huge reversal. This market got up today to as high as 521 3/4, let go at the end of the day, came down for the lows at 487.5, and finished the day near the low at 490.5, under all of yesterday's range and in here. So somebody was waiting for this market up on those highs. Now, when we look at momentum, both numbers are not over 80. So you just have an overbought market, that's how I'm viewing this, that hit its upper targets. On yesterday's reports that some of the wheat's doing worse than thought in terms of the growth pattern, the market went up and somebody was waiting. In sugar, I will not be surprised if the upper Bollinger Band acts as the first resistance, if the market can get to it. The trend is up, higher lows, higher highs. The bias is up. You're over the 18-day average. And momentum is up. So I think for the moment, the bulls have grabbed the trend. They own it. Support possibly coming in at that 1177 zone. It's about from 1142, 35 points or so? That's the number that has to be defended. But I don't think the bears even want to keep this market, or the bulls want to allow the market to stay very long under the 18-day average. Here's why. This is their first real pop where it closed over it. All this time it did not. Was that just a fluke, or is there more to this? In coffee, to me today, this was a big number. And as we talked before, I still think you've made a rolling bottom in the market, but I think the pros are out now. I think that at that 100-day average, they probably have cleared the decks, and they're waiting for the market to pull back in here, see if it embeds or if it goes into a correction. It's overbought. It's now a couple of days over the Bollinger Band top and at a major, major average. If we go back, you haven't seen a 100-day average in a long time. In the cocoa market, you still have the pattern of higher lows, higher highs, but I'll keep with what I said. I think the pros against these Bollinger Bands have been coming out, and on the breaks trying to buy the market. I think they're all looking, if they understand momentum, at what their different oscillators are telling them. Not everybody uses slow stochastics. Mine is saying both numbers over 80, both over 80, both over 80, so I have an embedded reading. When and if, and it eventually happens, the red line closes under 80, I'm no longer bullish. I'm looking for price in the 18-day average to come together. It's not here at this point. Therefore, until that occurs, I think on the pullbacks, the bulls are still in control of the market. In the cotton market, you've got up to a very important zone. From this whole rally, when you lost the embedded reading, you got to the 18-day average, and you're now running out of momentum. You can just see, yesterday you got up finally to that number. You hadn't been there. Today you got a bit higher, and then you finished lower, literally on that number. Now you're just sort of waiting to see, can it do anything? But it's come pretty far off these lows. I don't think you're going to get the technicians overly eager unless they hear of a weather issue in cotton. And from what I'm hearing, I'm not seeing that that's the case right now. In the cattle market, battleground is the 18-day average of closes. It just keeps hanging there. It's not following through to the downside. It's not following through when it tries to rally to the upside, and momentum has gone flat. I don't see a trend in this. In the feeder cattle, today, let me get back to this. Feeder cattle today was an important day. Yesterday we were talking that the market had lower highs. Now the question was, what do you do from these two lows? If it takes this out, then it keeps the trend down, but the Bollinger Band's waiting for you right here in an oversold market. You went down, hit the Bollinger Band from there, and that number was 141, let's call it 10. You finished at 142.72. So I'm going to stick with what I teach. I think the pros on the first challenge of a Bollinger Band after sideways action, they step out of markets. In the hog market, again, coming down, this was Friday, Remember, we weren't open on Monday. Support levels right through here. You break right through them. You're trying to follow through and you don't get it. None at all. Now, the market was stymied at the 100-day average on the way back up. But if the market decides to lift further, the 18 comes back into play. Are you trending? You're not. You have a higher high, lower low, but I think that the bears did a lot of short covering in this general area over the past 3 trading sessions. You know, one of the things I like to do is teach. If you watch these videos, I think you get an idea of it. And I teach a different way. I believe in rote. I think if you see something to do and learn how to follow that, it's a way to learn. So I created a course to do that. It's 54 video chapters. And you follow what I do, and yes, you're going to use some old data at first, but in the mornings, you're going to catch up with me because that's where my morning video is. And what I do in that video is I review 40 futures charts and approximately 5 ETFs each morning, Monday through Friday. And now you're getting to work with your swing line. You're beginning to see it because I make sure I cover everything for the student and for the regular subscribers after they've taken the course. I teach you my methods of moving averages, and there's more than you see in these videos. I cannot put everything I do on these charts. It would confuse you. To the student looking at it, they're going to go, I see it. And that's the idea of how I teach. I teach you how to do it first by hand, even moving averages. I show you the formulas. Then I walk you onto the chart, what you're looking for, and day by day I walk it. A lot of the videos, I take out the name of the chart. I want you to look at price action, then I surprise you and put it back in so you get to see what it is. Because the reality is, unless in the futures market there's a major report or event, let the chart do the talking. If you know there's a major report coming out, why are you standing in front of it? I mean, different things, the way to think. But Bollinger Bands, window envelopes, slow stochastics, chapters on chapters, about 6 hours of videos that you have here. So it's quite a bit. You get access to my market research with the course. You get a trial of our free trial to our charting software for the course duration if you've not used it. And we have 2 different types of charting software. So whether you've had one, probably didn't have the other. One's Java-based, one's window-based. And then it's all about the discipline. Now, the course retails for $169.95 right now. I can tell you, next week it's going to $179.95. The holiday pricing for all this, $99.95. The charting software itself is near $100. Then you get the value of my research, which is $60 a month for a non-client. That's $160. Where's the value of the course? And of course, the mobile phone access that you get as well. So it's all thrown in there. The value, quite a bit. $99.95. You don't even need 30 days. You will go through this course and under that. It's only 6 hours of videos. You go through it, you learn it. If you need more time, that can be arranged as well. So I'm Ira Epstein. You have a good day, and I will see you all tomorrow.